Hi, this is Roscoe at Small Business Buyer, and we're going to go over now a deal. It's a mystery deal because it's old and it is big. It's a big old deal, and we're going to go over it right now just real briefly. Make sure you guys understand why an old deal can apply to a new deal. So let's figure out that first we got millions of dollars here, okay? That means this is a $13 billion piece of short-term debt. Well, what is this whole thing? Oh, it is short-term debt plus long-term debt, existing long-term debt plus subordinated debt, in this case Mike Milken and his convertible junk bonds. And then some sliver of capital, and what do you have? You got a $26 billion deal. Okay, so that was the debt structure. Now we're going to talk about the earnings and the sales. And so what do we got here? Well, we got tobacco. That's a hint. So we got food income and a total of almost $17 billion. And so what I think is if you took this $17 billion and you subtracted 3 zeros, you'd have $17 million. And that's very easily applied to some of our deals we do today. So $17 million, and what do we got for EBIT? Almost $3 million, less interest expense, less some taxes, and you got an EBIT or a net income of $1 million. Hey, that's just like our deals today. So now we got total assets of $17 billion, almost as much as the sales are. Long-term debt of $5 million. Working capital seems to be enough, and what do we have for a purchase price? Well, we just came up to $24 billion plus $2 billion, which was for fees and so forth. And so what does that mean for the multiple? Well, it could be about a 10 multiple, maybe not as much, maybe a little bit more actually, because if we're down to $1.3 million versus 24, that's going to be, I don't know, 15 plus 18 multiple. And if we use EBITDA, it's going to be perhaps a 10 multiple. Well, you would think a big public company like this, 10 multiple wouldn't be out of the realm of possibility. So that's how we're evaluating this, even in 1988. So next, we're looking at a set of projections. Now, you don't have to do a 5-year projection, a 10-year projection, but you do need to do about at least a 5-year projection or so for your banks when you're doing and financing a deal. So as we can see, this projection at $18 million is going up a little bit each year just to give the growth rate some respect. And then we're going to go back down here and look at what the EBIT is. Again, at $2.8 million was about the same as it was last year. These are all projected years past 1988 when the deal was bought. Then we go down here, we look at capital expenditures and so forth. We're down to $794,000 after closing. And that's our valuation. These numbers they wanted to do on a DCF method, which I don't agree with, but that's the way it was done back then. So they had a nice big valuation of $24 billion, and they're only throwing off about 790 after the first year. So go figure. Now we know our deals are a lot cheaper than that. They're going to be around 2 to 4 to maybe 5, maybe 3 multiple of EBITDA, but who cares about these big deals, because we're just looking at it to compare as to see if we can do it the same way. And finally, we see what the collateral package was. Well, here it is. It adds up to what, $24 million again in breakup value, but each particular operation is separate in its sale price. So 200 million, 300 million, they're all sale prices. Not exactly collateral, but a market value of each separate operation. Guess what? This is RJR Nabisco. The deal is right there, and it is one of the most iconic and important deals of the leveraged buyout history. And we see what it is here at $92 a share. That was the deal that took it by KKR. And so you don't always find where the assets all add up to what the purchase price was, but in this case that's what they did. They're going to sell off these operations to pay down the debt. That's the big structure of the day, and the investment bankers will pick apart this balance sheet and start selling it off piecemeal. So why is this deal important to us? Well, I'll go back to the structure, okay? Structure is not too different from what we do. Yeah, there's no seller paper, but big deal. You got $13 billion worth of short-term debt. You try and max out as to the bank debt, which is backed by the key collateral. Then you backfill it with the rest of the stuff, which is as much mezzanine and junk bonds as you can get, as much seller paper. In our case, seller paper is pretty much what substitutes for the junk bonds. A teeny sliver of equity, and the deal is done. So that's what the 1988 mega deal RJ Nabisco can bring to the table for us today.